Most traders automate strategies that are severely underdeveloped. They may have a decent entry logic in principle, but they overlook the elements that actually determine whether a strategy survives contact with live markets. Today we're breaking down the 5 essential elements every trading bot strategy must have. Fail to properly design and optimize any one of these, and you're building on an incomplete foundation. Let's start with the most obvious element, entries. Your entry logic is the foundation of your strategy. It's the answer to a simple question: why are you taking this trade right now? But here's what separates functional entry logic from the random signals that destroy accounts. Every entry should be based on an explicit assumption about market behavior. You're not just saying price crossed above this moving average, you're saying when price crosses above this moving average, I believe momentum is shifting in this direction and is likely to continue. That distinction matters because when your entries stop working, you need to know whether your assumption about the market has broken down or whether you're just experiencing normal variance. Good entry logic is also explainable. If you can't clearly articulate why your strategy enters trades, you won't know when to trust it and when to shut it down. You won't know whether poor performance is a temporary drawdown or a fundamental breakdown. Here's a practical example. A trend following entry might wait for price to break above a 20-day high. The assumption is that breakouts tend to continue. That's explainable. You can test whether that assumption holds in current market conditions. Compare that to an entry based on 15 different indicators with parameters optimized to past data. What's the assumption? When does it work? You can't answer those questions, which means you can't maintain confidence when the inevitable losing streak happens. So your entry logic needs a clear, testable assumption about market behavior, but entries alone are worthless without the second element. Entry qualifiers or filters. Raw entry signals will get you killed. A moving average crossover might generate 50 signals in a choppy market, most of them false. Your strategy needs filters that determine when to actually take those signals and when to ignore them. These qualifiers serve 2 purposes. They filter out low probability setups, and they provide confirmation that your core assumption is valid right now. Common qualifiers include trend filters. Maybe you only take long entries when price is above a longer-term moving average. That's filtering for trend alignment. Or volume filters. You might require above average volume on the entry bar, confirming that there's actual momentum behind the move. You can also use multiple timeframe confirmation. Your strategy generates a long signal on the 15-minute chart, but you only take it if the 4-hour chart shows bullish structure. That's filtering for broader context. The key is that qualifiers should reinforce your core entry assumption. If your entry logic assumes trend continuation, your qualifier should verify that you're actually in a trending environment. Don't just pile on random filters hoping to improve backtest results. Now, once you've determined when to enter and which entries to take, you need to decide how many times to enter. This is the third element. Entry pyramiding and scaling. Should your strategy enter once and wait for the exit, or should it add to positions as the trade moves in your favor? These are fundamentally different approaches with different risk profiles. Single entry strategies are simpler. You enter once, set your stops and targets, and let it play out. This works well for mean reversion strategies where you're expecting a quick move back to equilibrium. Pyramiding, adding to winning positions, can amplify gains during strong trends. Your initial entry captures the beginning of the move. As price continues, you add another position and potentially another. Each additional entry increases your exposure to a trade that's working. But pyramiding also increases risk. You're committing more capital to a single trade idea. If the market reverses, those additional positions turn into additional losses. You need careful position sizing rules to prevent any single trade from destroying your account. Then there's averaging down, sometimes called martingale. This is where you add to losing positions, reducing your average entry price. This approach is dangerous and requires strict controls. The math can work. If you're trading mean reversion and you're confident price will bounce, averaging down reduces the recovery distance needed. But if you're wrong about the bounce, or if your timing is wrong, you're compounding a bad trade. The critical rule: only average down if your strategy is specifically designed for it, and only with strict maximum position limits. Never average down on trend following strategies. You're just adding to a trade that's going against you. So decide how your strategy handles multiple entries. One and done, pyramid into strength, scale into weakness. Each approach has valid use cases, but they require different risk management. Which brings us to the fourth element: position sizing and order quantity. How much do you risk on each trade? This determines whether your strategy can survive a losing streak or whether a few bad trades wipe you out. The simplest approach is fixed quantity. Every trade uses the same position size, say $100 or 0.1 Bitcoin. This works, but it ignores account growth and it doesn't adjust for market volatility. Fixed percentage of account is better. You risk 1% of your total capital on each trade. As your account grows, your position sizes grow with it. As it shrinks, your positions shrink, preserving capital during drawdowns. But the most sophisticated approach is dynamic position sizing based on volatility. When markets are calm, you take larger positions because the risk per dollar is lower. When volatility spikes, you reduce size because the same price movement represents more risk. You can implement this using ATR, average true range, or Bollinger Bandwidth. Calculate current volatility, compare it to average, and adjust your position size accordingly. This keeps your actual risk consistent even when market conditions change. Here's what matters. Your position sizing should ensure that no single trade or even a series of losing trades can destroy your account. A good rule is never risk more than 1 to 2% of capital on any single trade. With pyramiding or averaging, the total exposure across all entries should still respect that limit. Position sizing is where math meets psychology. You need positions large enough to make meaningful returns, but small enough that you can sleep at night during losing streaks. And finally, the fifth element that determines whether your strategy actually makes money: exit logic. Your exit rules need to accomplish three things: lock in profits when the trade works, cut losses when it doesn't, and give the trade enough room to develop before doing either. The simplest exit is fixed take profit and stop loss. You enter a trade, immediately set a take profit at 2% and a stop loss at 1%. When either level is hit, you're out. This provides a clear risk-reward ratio, and it's easy to backtest. But fixed exits don't adapt to market conditions. Sometimes your trade has much more room to run. Sometimes it needs to be cut faster. Partial exits give you more flexibility. You might take half your position off at your first target, then let the rest run with a trailing stop. This locks in some profit while keeping exposure to larger moves. Trailing stops adjust your exit as price moves in your favor. When you enter long and price rises, your stop loss rises with it, eventually moving to break even and then into profit. This lets winning trades run while still protecting gains. Long spread edges close positions completely on the exit signal. You're long, you get a sell signal, you close the entire position. You're flat until the next entry. Other strategies swing between long and short. When you get a sell signal, you don't just close your long position. You simultaneously go short. This keeps you constantly positioned, never flat. This works for trend following in trending markets, but it's dangerous in choppy conditions where you're getting whipsawed back and forth. The key question is, what market condition is your exit designed for? Fixed targets work in range-bound markets. Trailing stops work in trending markets. Partial exits work when you're uncertain. Choose exits that match your entry assumptions. Here's the reality. All 5 of these elements work together. Your entry logic makes an assumption about the market. Your qualifiers verify that assumption is valid. Your pyramiding rules determine how much conviction you put behind that assumption. Your position sizing determines how much capital you're willing to risk on it. And your exit determines how you'll respond when the market either confirms or denies your assumption. Change any one element and you change the entire strategy's behavior. This is why you can't just copy someone else's entry logic and expect it to work. You need to understand how all 5 elements interact. Let's put this together with a complete example. A trend following strategy. Entry assumption. Breakouts above recent highs tend to continue. Entry signal. Price closes above the 20-day high. Entry qualifiers. Only take longs when price is above the 50-day moving average and volume is above average. This filters for established uptrends with momentum confirmation. Pyramiding. Add 1 additional position if price moves 5% higher. Maximum 2 total positions per trade. This increases exposure to strong trends while limiting total risk. Position sizing. Risk 1% of account on initial entry, 0.5% on the pyramiding entry. Total maximum risk is 1.5% across both positions. Exits. Initial stop loss at the recent swing low. Once price moves 10% in profit, move stop to break even. If price hits 15% gain, take half the position off and trail the remainder with a 5% trailing stop. This strategy has clear logic at every level. The entry assumes breakout continuation. The qualifiers confirm trending conditions. Pyramiding captures strong moves. Position sizing limits total risk. Exits protect capital while letting winners run. Now compare that to buy when RSI crosses above 30, sell when it crosses below 70. That might work in certain markets, but what's the assumption? When do you pyramid? How much do you risk? When exactly do you exit? Those questions aren't answered, which means you don't really have a complete strategy. So here's your framework. Every trading bot strategy needs 5 elements working together. 1. Entry logic based on a clear assumption about market behavior. 2. Qualifiers that filter for conditions where that assumption is most likely to hold. 3. Pyramiding rules that determine how many times and when to add to positions. 4. Position sizing that keeps risk consistent and protects your account. And 5. Exit logic that locks in gains, cuts losses, and matches your entry assumptions. Build all 5 elements. Understand how they interact. Test them together, not in isolation. That's how you create a trading bot strategy that can survive real market conditions. If you're ready to automate strategies with all 5 elements properly defined, Tickerly lets you execute any TradingView strategy exactly as you've designed it. Multiple take profits, dynamic position sizing, trailing stops, everything we've discussed today can be automated through Tickerly's execution infrastructure. You build the strategy. Tickerly executes it precisely without the missing components that cause most automated strategies to fail. Start your free trial at tickerly.net and see how professional execution transforms your trading strategies.